Thanks for clicking! The Toronto Regional Real Estate Board has just released Toronto's real estate data for the month of October, showing a market that is continuing its downslide, with the benchmark average and median price all dropping, with sales falling to their third lowest October for the past 12 years.
Shocking.
And this dismal data comes as we're seeing numerous reports of forced sales, delinquencies, and defaults throughout the Toronto area. But in contrast to what we saw last year, it's not just private lenders seeing the majority of the stress, with even medium-sized banks like Equitable Bank showing big increases in delinquencies, and we're also seeing it out of the big banks as well, with even a recent report from CIBC warning of more problems to come in 2026. So what I want to do today is go over Toronto's real estate data for the month of October, take a look at some of these reports showing increases in powers of sale, delinquencies, and defaults, and then discuss some implications. Canada's national real estate data is set to be released in a little under 2 weeks' time, and we'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, that's the price of a home that represents the most popular set of features, which was down in October. September seeing a benchmark of $960,300. In October, moving down to $956,800. So that's a $3,500 drop in 1 month's time on the benchmark. Also down $103,500 since this point in time last year, back when we were being told that the rate cuts were drawing the buyers back into the market.
Don't you feel ridiculous now?
Next, the average price, which also dropped. Toronto's average in September was $1,059,000. That dropped down to $1,054,000 in October. So the average price down about $5,000 since last month, down about $81,000 since this point in time last year. The median price also dropped. The median price, that's where half as many homes sell over that price, half as many sell under that price. That was sitting at $909,005 in September, dropping almost $10,000 to $900,000 on the nose in October. So that's a drop of about $10,000 since last month. Also down about $60,000 since October 2024. Next, the sales to list price ratio, the SLPR, which didn't really change. The SLPR measures how much over or under asking the average home sells. So if a home is listed for $1 million, sells for $950,000, the SLPR would be 95. Toronto's SLPR was 98 in September, staying at 98 in October. And finally, the months of inventory measurement, the MOI, which measures if no more homes came to the market, how long would it take for Toronto to completely run out of homes for sale. That popped up again in October, coming in at 4.6 in September, and then 4.7 last month. And while that is an increase in the MOI, if we look back over the past 12 years, that is the highest level of months of inventory that Toronto has seen, not just for October, but for the past 12 years.
Everything is about to change.
So we've got the benchmark price down about $3,500. We've got the average down about $5,000. We've got the median down about $10,000. Homes are still selling for 2% under asking, and we have more relative inventory sitting on the market. And the prices make sense when we look at the dismal sales data, with sales coming in at 6,138, down 10% from this point in time last year, and the third lowest sales numbers for the past 12 Octobers. New listings coming in at 16,069, the second highest in the past 12 years, leading to active listings coming in at 27,808, by far the highest level of active inventory Toronto has seen heading into November. All of which, all of the sales data, all of these new listings, not great for the market moving forward. Or, as the media put it, what took so long? Usually the articles are out within minutes. Were you waiting on word from the Real Estate High Council on how best to spin October's data?
But listen up.
And it's likely that these price decreases are going to continue for the foreseeable future, as the Toronto Star is reporting on major increases in power of sale listings, showing the following chart with the biggest increases coming from Brock, Ajax, Stouffville, Oshawa, Brampton, etc. Now, I usually like to double check any data from any realtor because, well, you know. But this time we can't, as even the article points out, you need to be able to search MLS to be able to find these power of sale listings, and the searchable MLS database is only available to realtors. So, unfortunately, we're kind of depending on the realtors to provide us with early warning signs of stresses in the market.
That's not happening.
But I do think there are a few inferences that can be drawn from the data that is provided. First and foremost, there does appear to be a positive correlation between those with the biggest increases in power of sale and those with the biggest price declines. Brock, Stouffville, Brampton, etc. Which makes sense, as we've discussed before on this channel. Just as much as rising prices hide a lot of problems, falling prices tend to expose them. Now, the Star article doesn't give the exact story of the featured case, but it does say that the homeowner had been with River Rock since 2022. River Rock is a mortgage investment corporation, basically a private lender that will lend when borrowers have been denied by the banks. But private lenders based primarily off of equity. And as we've seen since 2022, Toronto homeowners have lost an awful lot of equity, down now about $400,000 since peak on the benchmark price.
Fundamentals of our businesses are very strong.
So when bills pile up and the equity isn't there, borrowers are limited in their options. They can't borrow new money to pay off old money. People run into problems, which leads to a power of sale. And while we did see major increases in power of sales and distressed listings coming from Toronto just last year, we're now seeing increased pressures on the alternative lending side as well, with Fairstone and Equitable Bank seeing their impaired loans surging over the past year much higher than pre-pandemic. And of course, after it starts with the private lenders, it then moves on to the alternative lenders and then moves on to the banks, which is what we're seeing, with the Bank of Montreal and CIBC both seeing major increases in delinquencies as well. And according to John Pasalis, realtor with Realosophy, this could just be the tip of the iceberg, noting that for every 1,000 power of sale listings, there is another 2,000 or 3,000 households behind on their payments. Now, obviously, I would have liked to see a data set to back up that statement, as it is a bit disconcerting to think we could see 2 or 3 times the number of power sales coming to the market any day now. If that is in fact the case, then these power of sale listings that we're seeing in Brock, Stouffville, Brampton, etc. could just be the beginning. And a recent report from CIBC actually supports this view, noting that current consumer debt levels do not bode well for 2026 renewals, which they expect to worsen in the second half of 2026. And then we had more recent data coming from Morningstar confirming this view as well, that this renewal wave is going to continue to be a problem, as it notes that the majority of the mortgages that are going bad have already been renewed, which makes sense. Alternative lenders tend to only offer 1 and 2 year terms. But if that's the case, if it's those mortgages that have already been renewed on the alternative side, those 1 and 2 year loans, and we know that 2026 is when the renewal wave really starts to get worse, then that's not a great sign for the market next year. And these increases in stress that we're seeing is really a dual story. It's one of mortgage resets, mortgage renewals, where buyers are facing much higher payments than they had for the past 1, 2, 5 years. But it's also a story of declining equity, which augments the previous story. For the past 3 years, maybe not so much last year, but for the past 3 years or so, most problems could be hidden by the equity that was in people's houses. They could refinance their home at renewal, pay off a lot of the credit cards. That helped to make the new higher payment more manageable. But given that you can only borrow up to 80% of the value of your home, and home prices are devaluing very, very quickly, that's limiting people's options. And I think we're starting to see that very much show up in the lending data. We've been seeing it in the private lending data for some time. It's moved to the alternative lending and is now hitting the banks as well. It's not emergency levels at the big banks, it's not emergency levels at the alternative lending. But as even CIBC is noting, 2026 could be far, far worse. And remember, all of this is with a 7.2% unemployment rate, which probably won't hold for much longer. So in summary, Toronto's real estate market continuing its downward slide and more problems showing up on the side of the banks. We will obviously continue to track how Toronto's market plays out on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.